Welcome to our deep dive on choosing between a high-deductible health plan and an exclusive provider organization plan. Instead of guessing, we will show you how to model your likely costs and make a confident choice. Let's begin by outlining what's ahead so you can follow along step by step. Here is today's agenda. First, we will discuss why this decision really matters financially. Next, we will define HDHP and EPO in plain language. Then we will uncover the 4 critical numbers that determine your best choice. After that, we will model 3 spending scenarios and walk through a sample comparison. Finally, we will end with an actionable checklist and quick quizzes. To set the stage, many people default to picking a plan based on instinct or the lowest premium. However, that approach often costs families thousands each year. By reframing this as a financial modeling problem, you can make an evidence-based choice and control your risk. Before we proceed, this video is for educational purposes only and is not financial, medical, legal, or tax advice. Plan features and rules vary by employer and insurer, and regulations can change. Please verify details with your HAR or benefits administrator, insurer, and a licensed advisor or tax professional. Emergency coverage and network rules differ by plan. Always confirm your specific policy terms. Now, with that groundwork set, let's compare the 2 plan types. Let's start with the HDHP. With a high-deductible health plan, you typically pay lower monthly premiums. In exchange, you take on more upfront risk because you pay the full cost of most services until you reach the deductible. After that point, coinsurance applies. The big advantage is health savings account eligibility. If your employer contributes to your HSA and you do not use it, you are leaving free money on the table. Additionally, the HSA has a triple tax advantage. Contributions are pre-tax, growth is tax-deferred, and qualified withdrawals are tax-free. If you don't need the funds now, you can invest them and potentially use the HSA as a long-term retirement tool. With that in mind, let's move on to the EPO. By contrast, an EPO often offers more predictable spending because you may have lower copays and a lower deductible. Coinsurance may apply after meeting that deductible. However, EPOs typically have narrow networks. Outside the network, non-emergency care is usually not covered, which can lead to high costs if you need specific specialists. Emergency coverage rules vary by plan and jurisdiction, so check your policy, especially if you travel. Now that we understand the plan structures, let's pinpoint the exact numbers that drive the decision. Here is a quick side-by-side comparison. On the HDHP side, the strengths are lower premiums and HSA eligibility, including possible employer matching. The trade-offs are paying full price until you hit the higher deductible and taking on more early year risk. On the EPO side, the strengths are predictable copays and a lower deductible. The trade-offs are network restrictions and little or no out-of-network coverage for non-emergency care. With that context, let's zero in on the critical numbers that determine your cost outcomes. The decision ultimately comes down to 4 numbers. First, total premium cost, your annual payment just to stay insured. Second, employer HSA contribution. This is free money in an HDHP and must be counted. Third, the out-of-pocket maximum, the most you can spend in a worst-case year. Fourth, coverage percentages after the deductible, your coinsurance rate. Next, we will apply these numbers to 3 usage scenarios to see how each plan behaves. This timeline illustrates 3 distinct years of care: low usage, moderate usage, and catastrophic usage. For each scenario, you see when the deductible is met, when coinsurance applies, and if or when the out-of-pocket maximum is reached for each plan. The HDHP typically shows lower premium outflow across the year, but has a higher deductible and potentially higher out-of-pocket maximum. The EPO typically shows higher premium outflow, but reaches its lower deductible sooner and may have a lower out-of-pocket maximum. The HDHP track also highlights the impact of an employer HSA contribution, which reduces your net cost. Now let's ground this with a numeric example. Here is an illustrative comparison with simple round numbers. These are not your numbers. They are only examples. For the low usage scenario, the HDHP has $3,000 in annual premiums and receives a $1,000 employer HSA contribution. With $200 in allowed medical charges, you pay the full $200 under the deductible, resulting in a $2,200 net annual cost after accounting for the employer contribution. In the EPO, premiums are $5,500, and you might pay a $30 copay for the same visit, leading to a total of $5,530. For the moderate scenario with $3,000 in allowed charges, the HDHP pays the full $3,000 to meet the deductible, leading to a net of $5,000 when including premiums and subtracting the employer contribution. The EPO pays a $1,000 deductible and 10% coinsurance on the remaining $2,000, or $200, for a total of $6,700, including premiums. For catastrophic spending, assume $50,000 in allowed charges. The HDHP hits its out-of-pocket maximum of $7,500, yielding a $9,500 total when combined with premiums and the employer contribution. The EPO hits its $5,000 out-of-pocket maximum, producing $10,500 in total, including premiums. Depending on your real premiums, employer HSA, deductibles, coinsurance, and out-of-pocket maximums, your result can differ. This is why you must model your specific numbers. To put this into action, first gather your plan documents and benefits summaries. Next, extract the 4 critical numbers: total premiums, employer HSA contribution if applicable, out-of-pocket maximum, and coinsurance percentages after the deductible. Then estimate your medical spending for 3 scenarios: low usage, moderate usage, and catastrophic. Calculate your total net annual cost in each scenario for both plans, making sure to subtract any employer HSA contributions from the HDHP totals. Also, stress test out-of-network risks for the EPO and early year cash flow exposure for the HDHP. Finally, select the plan that yields the best net outcome across your most likely scenarios. Let's formalize the math. The HDHP net cost equals premiums plus your out-of-pocket spending up to the out-of-pocket maximum, minus any employer HSA contribution. The EPO net cost equals premiums plus your out-of-pocket spending up to the out-of-pocket maximum. For coinsurance, if allowed charges exceed the deductible, calculate the portion above the deductible and multiply by your coinsurance rate. Then add the deductible amount, but never exceed the out-of-pocket maximum. If allowed charges do not exceed the deductible, your out-of-pocket is simply the allowed charges. Also, if you contribute to the HSA, consider potential tax savings, which can lower your effective cost, though those savings will depend on your tax situation. Now, let's test your understanding. Quiz time. The question is, which 4 numbers should drive your HDHP versus EPO decision? Here are your options. Option A: premiums, employer HSA, out-of-pocket maximum, coinsurance after deductible. Option B: premiums, copays, number of doctors in network, pharmacy location. Option C: deductible, brand of insurer, state, number of dependents. Option D: coinsurance, gym discount, vision benefit, dental network. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the combination of premiums, employer HSA contribution, out-of-pocket maximum, and coinsurance after the deductible. These figures drive your exposure in low, moderate, and catastrophic years, and they determine how much you actually spend. Second quiz. The question is, what is a primary risk with EPO plans? Option A: you must pay 100% until the deductible regardless of service. Option B: out-of-network non-emergency care is typically not covered. Option C: HSA contributions are mandatory. Option D: EPOs never cover emergencies when traveling. You may pause the video now to consider your answer. We will review it in the next section. The correct answer is that out-of-network, non-emergency care is typically not covered by EPOs. Always verify your plan's emergency coverage rules, especially if you travel, because policies vary. Here are the key points. Do not choose on premiums alone. Use the 4 numbers to build a simple model. Run the 3 scenarios of low, moderate, and catastrophic usage. Include the employer HSA contribution as a direct cost offset. Finally, stress test EPO network risk and HDHP early year cash flow exposure before deciding. To wrap this up, some profiles tend to align with each plan type. An HDHP can be attractive if you have a strong employer HSA match, and you can handle early year costs before hitting the deductible. An EPO can appeal if you value predictable copays and are comfortable staying within a defined network. If you travel frequently or anticipate specialty care, examine network and emergency rules carefully. As always, confirm the details in your actual plan documents. In summary, treat this decision as a math problem. Gather your 4 key numbers, model low, moderate, and catastrophic years for each plan, and then pick the plan with the best overall net outcome for your household. With a structured approach, you can remove guesswork and improve your financial confidence. Thank you for watching. If this was helpful, please like, share, and subscribe. Post your scenario in the comments, and I will help you think through the modeling approach. See you in the next video.